You're saving me 600,000, Josh. Mike writes in from the great Northeast, and it's actually pretty cool. This makes you happy. Let me make this a little bit bigger. And he gives us a lot to chomp on here. And while I appreciate the accolades, my ability to bring to Mike's attention isn't me saving him money. It's his ability and his openness to hear. Maybe there's a different perspective, and thus using that info and using it to benefit for him and his wife and family. So if this doesn't fire you up, my friends, nothing will. And just think, as I go back to preaching, you doing your own YouTube video, what could you be doing to get people fired up where they might not save $600,000 but live happily, whatever it is? I don't know. But anyway, so let's read this. Mike says he's just a math guy. I think a lot of things can be explained and figured out by math. I'm a card counter as well. Been banned from, he told me, the casino, which I won't say. I've been banned for 20 years from that casino. So he's transitioned to poker, which is laced with even more math, and he built his own app that blah, blah, blah. So I'm not going to talk about that. But he's not, he's not a shrinking violet by any stretch of the imagination. He's a math guy. And if you knew his background, you'd understand that this guy has chops in order to understand how things work from a mathematical perspective. So, and when he says I'm saving him $600,000, that's fantastic. All right. So what he's doing differently now, he's converting all future contributions at the same contribution level to a Roth instead of the pre-tax 401k that he's always been. This means I'm contributing exactly what I would have for the pre-tax 401k as I will for the Roth. Does that make sense? So nothing's changing, just one's going to the Roth, it's not going to the 401k. At age 60 and 61, he'll roll over his pre-tax 401k funds so he doesn't have to write a check to pay the tax. So I was wondering, when I read that, I was like, huh? But then he says he'll pay the tax out of that 401k, which he won't be penalized for because he'll be older than 59 and a half anyway. Remember, even if you're under 59 and a half, folks, you can do a conversion anytime you want. There's no 10% penalty. Just keep that in the back of your mind. So I wasn't sure if Mike recognized that or not. Doing conversions are one of the exceptions to the 10% penalty rules. That makes sense. But anyway, he said he's going to do it at 60 and 61. And he'll have the taxes taken out of the 401k as opposed to paying cash. Now, some people say, "Well, don't do that." But Mike, he's ahead of you, my friends. Before you start saying, "Don't do it," he trust me. Let's see. I prefer to decrement my 401k balance by the tax amount than through my checking account. I guess deplete. I would say. I've never heard the term decrement. There might be a term. I just don't know. I'm from Maine, so we don't know these big words. He prefers to deplete his 401k balance by the tax amount rather than through the checking account. The only extra money this is going to cost me out of pocket is the tax I'll have to pay on my Roth after-tax contributions for the next 9 years. This approximately equates to about $3,000 a year or $27,000 overall. So he's saying essentially by contributing to the Roth as opposed to the traditional, it's going to cost him $3,000 a year more in tax in his 401k. Now, when he stops working, he'll do the conversions from his pre-tax 401k to the Roth. He will pay tax there, but it won't be out of pocket because he's going to take the whole thing from his 401k. My investment balance at the end of my work life will consist of a little pre-tax money that will be the result of my company's matching contributions that will not yet be taxed. The difference in approach results in the following account balances. So old, this is his old approach, pre-tax 401k only, pre-tax $952,000 plus $114,000 in a Roth account. I've always planned on a small Roth account for these years in which I'd like to contribute beyond the $24,500 contribution limit for those over the age of 50. So basically he's going to have roughly 1.1 million, of which 93% essentially will be in the pre-tax, and a tiny amount will be in the Roth. But now with the new approach, he calls it the Josh approach, his pre-tax 401k will be the $76,000 plus $847,000 in a Roth account. Now, here's where I'm telling you, this guy figured it out. You're saying don't pay tax with your after-tax, with your 401k, do with after-tax money. But he takes this into consideration. Note, the overall investment balance is approximately $140,000 lower for the Roth due to the need of paying the taxes during the rollovers. He's paying the taxes from the account. So essentially he's taking $70,000 a year out in order to pay the taxes. Thus, when he's retired, he won't have $952,000 plus $114,000. He'll have $847,000 plus $76,000. Hope that makes sense. The assumptions during my retirement are identical for each approach. They are the same year budget, year one budget, $100,000 with a 2% inflation. All right, so he's saying I'm going to use $100,000 in my first year budget, $102,000 next year, $102,400 the following year, whatever it is. The same annual return on investment of 4%. So he's not swinging for the fences here. Identical COLAs of, he's only using Social Security cost of living adjustments of 1% a year. My preference would be 2.6 because that's what the trustee says. But no, I get it. I get what we're doing. The same Social Security income yearly benefit as well. All right, so everything going in are the same. All the inputs are the same. The outputs are where they diverge. And here he's got his nice spreadsheet. So observation. So he got 401k, the traditional approach, the Josh approach. He has 1.2 million in his total Roth / 401k distributions, or 1.1 in his Roth. All right. Now there's a $12,000 difference. When was this? How they diverge? Let's see. Okay, we'll just keep going. Okay, this is, I guess, at his end of. Let's see. At the end of retirement. Okay. He'll have 1.5 million in Social Security on either side over the payout. He'll have 41,000 as average taxable Social Security income. Yep. Okay. Good. So look at this. He's saying he's gonna have 41,000 as average taxable Social Security income over the course of his life at retirement. When under the 401k, because of all the required minimum distributions. Under the Roth, though, he only has 16,000. So Roth is better there. Does that make sense? Not much of a difference in terms of overall 401k versus Roth. Now remember, he's starting his 401k with $140,000 more. All right, he's starting his 401k with $140,000 more, but the 401k has those required distributions, and after taxes, we'll get into that. But he's starting his Roth with $140,000 left without any RMDs. When all is said and done, it's only $12,000 more in the 401k than the Roth, but the 401k still has a significant tax hit, which we'll show you about. All right, average taxable yearly income, $99,000 with the 401k mode and only $24,000 with a Roth. I mean, the average taxable income is only $24,000 in the 401 in the Roth if he did everything into the Roth, whereas $99,000 if he did the traditional where you're deferring. Total taxes paid in retirement, $607,000 in the 401k versus $103,000 in the Roth. The Roth is better by $504,000. That's nuts. Investment balance after retirement, after tax money, at end of retirement. So when they die, $223,000 in the 401k, $826,000 in the Roth. Investment balance at end of retirement, after tax dollars. Surviving spouse's tax bill, $89,000, and surviving spouse's tax bill into the Roth, $0. Thus, the Roth is better by $603,000. It's freaking nuts, man. I mean, that's nuts. $603,000 after tax. Because the 401k has required minimum distributions, which flow into taxes on your Social Security, flow into taxes on your required minimum distributions, all other things. It flows into tax on your Medicare. It's nuts. Flows into tax on capital gains. We've talked about this a million times this Sunday. Here are some additional interesting pieces of information. I ran the analysis for each approach, taking my Social Security income at 60 and 70. The Social Security payout for each scenario was almost identical at $1.5 million overall. However, my ending investment balance at the Roth Social Security at 70 was $600,000, which was $200,000 less than taking it early. This surprised me. You really scared me when you spoke about the surviving, and I want to talk about that here in just a second. You really scared me when I spoke about the surviving spouse, and it's true. The Roth approach has allowed her not to pay any tax at all during this period because the only taxable income she'll have is her Social Security income of $42,000, which won't be taxable because after her standard deduction, Her taxable income is $77,000. Let's see, because after her single standard deduction of $13,300, it leaves only $7,700 of provisional income, which isn't taxed. I mean, this again proving once again that Social Security is not taxable when it's your only source of income. It's just not. For me, for people like me who to really believe this stuff, because I had to prove it to myself with my own numbers, is important for us to be able to input our numbers and see all the calculations and not just results. When we only see the results, we tend to question the white magic behind the curtain. We simply don't trust as much. No, I completely agree. The model you're creating will be very helpful to a lot of individuals. Okay, how's that? I watch a few videos. How's that? I watch a few videos and make, save, earn $600,000. I know if it can make a difference to my retirement, it can make a difference to those who show an interest. Basically, you got to show an interest. Can't be ignorant. I find that almost everyone I know doesn't have a clue about this stuff, and I've been the most well-versed in this area and always look at what I'm missing. I'm a god, Josh, you're a godsend. And it's all wonderful. I love it. I mean, I think that's 100% correct. People are just, actually, I was reading a quote. Let me share this with you. This guy texted me last night, who's in the business, by the way. Let's see, hold on just a second. So he shared me this quote, basically from a guy in the business. The majority of financial services companies depend on the ignorance of their customers. Unfortunately, most customers never realize this. I completely agree. Completely agree. Hey, that's pretty cool, man. Oh, I did want to talk about this taking it 200,000. Mike had emailed me earlier about taking $200,000 less from his from taking his Social Security earlier and making more money. And he actually had a 4%. I chuckled because of 4%. If you can get 4% on your money, it makes sense to take Social Security early, but it doesn't make sense to take it if you're still working. I just telling you, it doesn't. And the reason for that is because they keep $2 of your benefit every dollar you're over the threshold is like $17,000. So don't take Social Security early if you're still working. It's just hard to make that square peg fit the circle. It really is. So anyway, I thought that was pretty interesting, and I love it. So that's fantastic. If I can save a family $600,000 from the tax man to be wasted on whatever building new stadiums for multi-billionaire football owners, it's wonderful. So thanks, appreciate it, and hopefully I can save you some. Do what you can, my friends, to try to share. Look, obviously sharing my videos is important for me, but just I don't know how you deal with ignorance. People, if they don't want to know, they don't want to know. I don't know how you get around that, but man, the ignorance is costing them money. And just the thing that ticks me off, my whole thing with my private plane diatribe on financial advisors, they're flying around these planes at the expense of their clients who are just middle-class people, getting by. And when the markets fall, they're still on their planes, these guys. But the middle-class people are sweating bullets, wondering if they're going to retire. And the only reason they can afford that is because of the ignorance of those middle-class people, that they think there's no other alternative, that they don't have the skill set in which to do it on their own. And they do. And so I wish you would tell people, you can do this. This is not rocket science. And maybe start with the John Bogle book. Obviously share my videos, but share Devin Carroll's videos. My man Dustin over at Jazz Wealth. But they're all alternatives to paying these guys and making them rich. There are. And the more people that find these alternatives, the better off we're all going to be. That's all I got to say about that. So appreciate you watching. Thanks, Mike, for the email. And thanks, guys. We'll see you next time.